If you don't control your money will control you. Have you ever considered whether $1 million is enough to live off the interest? It seems like a lot, right? Maybe it is, or maybe it isn't. What if I told you that $1 million could become a financial prison or a liberation, depending on what you do with it afterwards? Have you ever stopped to think how many people believe that having $1 million is synonymous with financial security for the rest of their lives? It seems like a huge sum, and it is. But the real question isn't the size of the number, but what it represents over time. Because idle money is not synonymous with freedom. And what if I told you that this million, if poorly managed, could become a big problem? Imagine someone who deposits this entire amount into a single investment, believing that the monthly returns will be enough to support the lifestyle they've always dreamed of. At first, it might even seem to be working. Depending on the investment, this capital could yield around $4,000 or $5,000 a year above inflation, if well managed. But then comes the big trap. Inflation, taxes, and mismanagement silently erode the purchasing power of that money. Every month that passes, you take a piece out to live. Prices rise, and what once seemed sufficient shrinks. How many stories have you heard of people who inherited a fortune or won the lottery, and a few years later had nothing? This happens because many people only look at the raw numbers, without understanding that what matters is the real yield. That is, how much is left after deducting all the invisible costs. And inflation is the worst of them. It doesn't come all at once, it doesn't shout, it doesn't attract attention, but it acts like a leaky roof. Day after day, it soaks, weakens, and when you realize it, a huge hole has opened up. $1 million that in 1994 bought a luxury house would barely buy a mid-range house in a large city today. The dollar has lost more than 80% of its purchasing power since then. And that's not an opinion, it's pure mathematics. And there's more. Taxes on investments in the United States, and in many other countries, bite into a considerable portion of the profits. If you invest in fixed income, for example, the government takes a slice of up to 22.5% of short-term gains. It's like cultivating an orchard, but with every harvest, someone takes almost a quarter of the fruit before you even touch it. Add that to inflation, and you begin to see why so many people reach the end of their lives with far less money than they imagined. Napoleon Hill, in his youth, experienced a situation that well illustrates this risk. He worked as a reporter, dreamed of getting rich, and even started his own business in the lumber industry. At first, it seemed promising, but mismanagement, lack of financial planning, and an unstable economy quickly turned the tables. Hill saw his assets swallowed up by debt and devaluation, forcing him to abandon everything and practically start over from scratch. It was a period of shame and fear. He even fled from creditors and spent years rebuilding his reputation. Now imagine the feeling. One day you think you have a secure future, and the next you have nothing. That was the punch in the stomach that forever changed how he viewed money and financial security. And here's a fact that bothers many people. Recent studies show that most people underestimate the impact of inflation and overestimate the profitability of their investments. That's why, even with seemingly high interest rates, the real yield, the one that actually increases your purchasing power, is usually much lower than you think. You may even earn 10% a year on a fund or bond, but if inflation is 8%, only 2% remains. 2% of $1 million is $20,000 a year. Does that seem like a lot? Divide that by 12 months, less than $2,000 a month. Would that cover all your bills? Now think, is the problem the money or the way you handle it? Because it's not just a matter of how much it yields, but also how you spend it, how you reinvest it, how you protect this asset against invisible thieves, inflation, taxes, and bad decisions. And the big question is, are you prepared to transform that $1 million into freedom? Or will you end up watching it slip through your fingers, as has happened to so many before you? The truth is that leaving money idle, waiting for it to grow on its own, is like planting a tree and never watering it again. At first it may seem strong, but over time it dries up, becomes fragile, until one day it simply ceases to exist. If you want your assets to grow and produce real income, you need to learn to make it work for you. And no, that doesn't mean taking reckless risks, as many people do when they hear about some miraculous investment. It means intelligence, strategy, and above all, discipline. The first step is to understand that there is no single magical investment capable of solving everything. This is where diversification comes in. Think of how many people bet all their chips on fixed income because it paid well, and when interest rates plummeted, they saw their returns shrink overnight. Others did the opposite. They put all their money in the stock market during times of euphoria, believing that the party would never end, and all it took was a crisis for them to lose half their assets. Diversification is like building a team. You need different players to win different championships. Fixed income provides security and predictability. Stocks, real estate investment trusts, and ETFs offer growth potential. Overseas investments protect against local crises and currency devaluation. When one fails, the other holds the fort. That's how you survive storms and still grow in the long term. Another crucial point is the reinvestment of earnings. It seems simple, but few people actually do this. Imagine that you invest in stocks that pay dividends or in real estate investment trusts that pay rent. If you simply spend everything you receive, your assets don't grow. They just stay the same size. But if you reinvest those returns, you take advantage of the power of compound interest, and then things start to get interesting. It's the famous money making more money. Warren Buffett, one of the greatest investors of all time, built his fortune primarily this way: buying solid assets, reinvesting profits, maintaining discipline and patience, even when the market seemed to go crazy. And so, while many frantically entered and exited investments, he simply continued to accumulate and grow, year after year. But here's a detail that almost nobody talks about. Multiplying your assets is not only about where you invest, but also about how you protect what you've already achieved. Taxes, fees, and inflation are silent enemies. There are legal strategies to reduce their impact: choosing more efficient funds, taking advantage of tax exemptions, using assets that already offer automatic protection against inflation. This is not greed, it's intelligence. After all, what's the point of seeking higher returns if the government or inflation is going to take an ever larger share before you can use that money? And all of this only truly works when you maintain discipline. You know that impulse to sell everything when the market falls for fear of losing more? That's exactly how so many people sabotage their own results. The investor who acts on emotion ends up buying in euphoria when everything is expensive, and selling in panic when everything is cheap. The disciplined investor understands that crises are part of the game, that downturns are opportunities to buy cheaper, and that, in the long run, the market tends to reward those who remain calm. Research shows that investors who follow a simple plan, with clear goals and the discipline to achieve them, end up with more money than those who chase the investment of the moment. And this brings us to a question that might be uncomfortable. Do you have a real plan for your money today, or do you just invest where you heard it's yielding well? Because it's this difference that separates those who make their assets grow from those who spend their lives merely reacting to the ups and downs of the market. And if all this seems laborious, remember, we're not talking about becoming a finance expert, but about taking control. Ray Dalio himself, a billionaire and founder of one of the world's largest hedge funds, says that diversification and balance are the secrets to protecting and multiplying wealth in any economic scenario. He lived through global crises, market crashes, high inflation, low interest rates, and still built a gigantic fortune because he always focused on strategy, not on the emotions of the moment. This is something that anyone can learn to do, even starting small. The truth is that making $1 million yield more is not about luck or magic formulas. It's about understanding how money behaves, creating a smart plan, diversifying, reinvesting, and having the discipline to follow that path even when everything around you seems chaotic. It's a long-term game. The question is, are you willing to play to win? Or will you continue to wait for the money to grow on its own, like a forgotten tree in the backyard? Many people believe that once they achieve $1 million fortune, the work is over. That from then on, it's just a matter of sitting back and letting the interest work its magic. But the reality is very different. What truly makes this money grow or disappear are the decisions you make every day. And most of the time, the problem isn't the lack of capital, but rather the mistakes people make in managing that capital. The first mistake is putting all your eggs in one basket, often a high-risk investment, believing you found the secret formula. It's the illusion of the miracle investment. A classic example is someone putting everything into the stock of a promising company or a single expensive property. It seems like a great idea when prices are rising, but all it takes is a crisis, a market crash, or a non-paying tenant to tie up a significant portion of your assets, or even lose it entirely. This lack of diversification turns $1 million into a ticking time bomb. The second error is underestimating inflation. Many people look at their bank statement and see their balance growing, but forget that purchasing power doesn't keep pace with that growth. Earning 8% a year might seem fantastic, but if inflation is at 6% and you still have to pay taxes on that return, your real gain might be almost non-existent. It's like running on a treadmill. You're exerting effort, but you're staying in the same place. Failing to review your real return, discounting inflation and taxes, is like closing your eyes while your money silently slips away. Another very common mistake is the so-called lifestyle effect. Someone reaches the $1 million mark, breathes a sigh of relief, and decides to finally enjoy life. They buy a more expensive car, travel more frequently, and raise their standard of living. But this new life requires more monthly income, and what once seemed sufficient no longer covers expenses. It's the phenomenon of increasing expenses at the same rate as income increases. The result? The wealth that should last for decades begins to dwindle in a few short years. There's also the lack of liquidity and an emergency fund. Imagine needing money quickly for an unexpected situation, but all your assets are tied up in real estate or long-term funds. What happens? You're forced to sell at the worst possible time, in a hurry, accepting low prices. This destroys years of building wealth. Having a portion of your capital in liquid assets, easily accessible, is what gives you the breathing room to handle unforeseen circumstances without compromising the rest. And we can't forget the risk of falling prey to promises of miraculous returns. People who have amassed $1 million become targets of unmissable offers, revolutionary startups, trendy cryptocurrencies, exclusive funds. This is where greed and the rush to multiply money become enemies. Countless are the cases of people who have lost everything in poorly explained schemes or poorly structured investments. What seemed like an opportunity to get rich quicker often turns into a shortcut to losing years of hard work. A historical example of how bad choices destroy wealth is the very trajectory of Napoleon Hill. After achieving some recognition with his books and courses, he became involved in risky businesses and projects that seemed promising, but ended up generating debt and accusations. His pursuit of quick, poorly calculated opportunities led to painful failures, proving that even those who understand the theory can err in practice. This type of downfall doesn't happen all at once. It starts with small decisions, with the idea that this time it will work out. And perhaps the most dangerous mistake is believing that knowing enough is enough. The market changes, the economy fluctuates, life throws curveballs. Those who don't review and update their strategy end up being swallowed by change. It's like navigating with an outdated map in a sea that has already changed shape. The result is getting lost, even though you set out with every condition for success. These mistakes aren't just numbers or technical concepts. They are real experiences of people who have seen substantial wealth turn to dust in a matter of years. And the feeling that remains is not just the loss of money, but also frustration, shame, and regret for believing they were secure, when in fact, they were unknowingly sabotaging themselves. It's this emotional weight that often destroys more than the financial loss itself, because it undermines a person's confidence to reinvest and rebuild. Therefore, the real secret isn't how much you have in your account, but how you manage each decision. Avoiding these mistakes can be the difference between $1 million that multiplies over the years, or $1 million that disappears before it even provides the peace of mind you've always dreamed of. If you have $1 million and truly want to live off your income, what will make all the difference is not just the investment itself, but how you structure a practical plan for that money to work for you. And that starts with something many people ignore: having a clear objective. It's not enough to simply say, "I want to live off my income." You need to translate that into numbers. How much do you need per month to live comfortably? $5,000 after tax? $6,000? $8,000? This answer is the starting point, because only with it can you calculate if your assets are ready to support that lifestyle. After that, the second step is to look at your actual expenses. Not just what you think you spend, but all fixed and variable costs, including those that appear once a year, such as taxes, insurance, or car and property maintenance. Many people are surprised to realize they need much more than they believed, and that's where the plan begins to take shape more realistically. $1 million may seem like a lot, but if your cost of living is high, it may not last that long. With the numbers in hand comes the more strategic part, how to allocate that money. A practical example would be to distribute 40% of the assets in fixed income indexed to inflation, to ensure security and stability in the long term. Another 30% could be in global stocks or ETFs, which bring growth and also currency protection in case of a devaluation of the dollar. 20% could be allocated to physical real estate or real estate funds, which, in addition to generating income, can serve as diversification against fluctuations in the financial market. And 10%, which may seem small but is fundamental, would remain as liquid reserves in highly liquid investments, ready for emergencies or to take advantage of good opportunities when the market is down. This portfolio is not something fixed, rigid. Every 6 months, or at most a year, it is essential to review and rebalance. If, for example, the equity portion has grown significantly and now represents 40 or 50% of the portfolio, it may be time to sell a portion and reallocate to more conservative assets. This ensures that you are not overly exposed to a single type of risk. The same reasoning applies when an asset loses value and represents very little. It may be a chance to buy more, as long as it makes sense for your long-term strategy. Another crucial point is to resist current trends. The financial market lives on waves. One day it's the cryptocurrency of the future, the next it's a revolutionary startup or a fund that promises above-average returns. Following these trends without deeply understanding the risk is like giving your $1 million to a stranger and hoping they know how to take better care of it than you do. The secret is to focus on the plan, not the headlines. And there's another detail that few people apply, but which can greatly increase security: setting aside a portion of the assets for opportunities. Large investors do this all the time. Ray Dalio, for example, has always advocated the idea of maintaining liquidity to buy when everyone is selling, during times of crisis. It is during these periods that quality assets become cheaper, and those with cash can transform the crisis into growth. Imagine having 10% of your assets ready to act when the market falls. That money can multiply much faster than if it were locked up in something illiquid. To put all this into practice, you can start with a simple challenge. Over the next 30 days, take your current investment portfolio, or even a simulation of it, and see if it covers the monthly amount you need to live on. If it doesn't, adjust it. Add a portion of assets that protect against inflation. Include an international component. Ensure you have sufficient liquidity. After 30 days, track the results and see how much is still needed to reach your monthly income goal. This exercise brings clarity and shows that it's not the assets alone that sustain the future, but how they are organized and monitored. With discipline, periodic review, and the courage to say no to market traps, that $1 million can not only support your life, but also grow over the years. And what seemed like a limit, a fixed value, transforms into a springboard, a starting point for a truly planned, stable, and free life. The most important point you need to take away from this is that it's not the value in your account that guarantees financial freedom, but rather the intelligent choices you make with that value. It's the planning, the discipline, and the clarity of objectives that transform an asset into a lasting source of security and peace of mind. And if this content made sense to you, like the video, subscribe to the channel and turn on notifications, because in the next video, which is already appearing on the screen, we're going to climb another rung in your financial wisdom evolution, so you can become 1% better than you are. Now, thank you very much for being here with me, and I'll see you in the next video.